Signature Bank, his bank. But for those of you who have had the privilege of going to one of their offices, I did last week, I walked into this office and all over the walls I saw playbills with different Broadway shows. And what I learned is that every Broadway show is a $60 million business that starts at one moment and ends shortly thereafter when the production closes. And it's filled with the most mercurial clients you can ever imagine, like actors that are flown in from England that apparently need accounts set up at midnight or something like that. And, you know, quite strikingly, this is a business that somehow gravitated to a very, very new bank. How old are you, 13 years?
12 and a half years.
12 and a half years old, because it had hired people from other banks. But somehow it was able to open an account for these crazy people at midnight, and a lot of the banks that maybe you and I deal with have not been able to do something like that. And I think what that reflects is that if you're nimble and smart and you understand the opportunities, there are many franchises in even the staid world of commercial banking that many of us do not understand. So I'm pleased to talk to a CEO who apparently does understand that these niches that exist and does know how to get them, and ask them about both this year, what you don't know, and maybe what's coming up in the year ahead. So let me start out by just asking you, what are we in the room not seeing that's going on right now that you with your customer base, and by the way, the customer base is it's 27 offices or so, right, basically in the New York region. They're all small and medium-sized businesses. They're all doing their business banking through your office. What are you seeing that we in the room are not seeing?
So I think there's a few things that are important trends that are beneath the radar screen. One of them is we've gone through a number of years, as we saw earlier, of slow growth. And I do get the sense that our clients are sort of itching to expand, to take some more risk. They've been cautious. They have been rewarded for being cautious. But they're looking for those glimpses. And so I think that one potential surprise is that if we see some positive movement in the economy, that we have some upside surprise to growth. The other thing that I think that is remarkably under-noted is that the level of low rates that we've had for the last years, which the Fed has put into place to essentially increase employment, has an interesting obverse effect as well, in that given that there haven't been growth opportunities, small and medium-sized businesses have been borrowing money at generationally low rates to actually save on labor. So they're replacing, which is economics 101, they're replacing labor with capital. Capital doesn't have any issues with respect to regulation, healthcare. There's no increases in cost necessarily. If anything, the cost of capital has been declining. So while we see that total employment is straining to get back to where it was before, at some point, low rates actually have an inhibiting impact on employment increase, and particularly on participation in the employment base.
I'm going to be looking around for questions, so if any of you want a loan, feel free to raise your hand. We'll get you an appointment right away. Beyond that, you know, if you want to approach more granularly anything that he says, anything Scott says, please raise your hand right away. I'll be looking at. Now, given your scenario, we all know, well, actually, I hate to use that phrase. It's generally thought that rates will rise, that QE 25 or whatever we're at ultimately has to end, and that normally, well, there is no normal because this has never happened before, but there's a tremendous amount of concern that when rates rise, the economy will fall, the stock market will fall. Given the scenario that you just outlined, in some ways that's an encouragement for employment to, in a sense, grow when you have a more normalized rate. So what do you think would happen? Well, A, what do you think a reasonable rate to expect would be? How much interest rates do you think could, reasonably go up? And what do you think the economic and employment effects will be on your clients, the small and mid-sized businesses that you have?
Well, I have to tell you, this is sort of the most expected set of rate increases that's probably also ever been around in a generation. So all of our clients, and I look at client presentations, I've said, if you want to borrow money, now's the time to borrow it. Figure out what you're going to need for the next several years, because frankly, banks are better at hedging and managing those risks than our small and medium-sized clients. And so I think a lot of people have done that. They've extended maturities. They've borrowed a little longer. And on the short end, for people who are managing, managing their receivables and inventory, frankly, low rates are probably going to stay here through 2015.
So the Fed was stunned when the market reacted as dramatically as it did to the increase or its suggestion that tapering would begin. Let's say they manage it a little more smoothly, but they still do what they're saying. Rates go up. What do you think would be reasonable? 100 basis points fairly soon? Or
On the long end, I think we could, if we're here a year from now, if this interview goes well, and we're talking, then I would be surprised if we don't have a 3.5% 10-year or better.
And what do you think that will happen? The impact will be on your lending, what you charge your customers?
Well, it's a competitive environment. I do think that'll increase, probably not, basis point for basis point. Spreads could narrow if the economy performs better. But I do think that rates are likely to go up, and I would make the same recommendation to anyone here in the room that I make to our clients, which is if you're thinking about borrowing, don't wait. Now's the time to borrow. Now's the time to extend.
So if they do go up, next year when we're talking, are you going to have any clients coming into the door then? I mean, what will happen to the economy if rates are that high? Will there be a sharp reaction, particularly because you're getting such, if they're listening to you, a flood of business right now?
Right. Well, we have had a very nice experience with respect to refinancing, and we've had substantial loan growth this quarter, and substantial loan growth in our leasing and our small and medium-sized business lending. So we are seeing that already today. I think if we get a positive, virtuous recovery, which I'm very hopeful that we will get, then I think that that'll be okay. Our business clients are not generally publicly held companies. They're family owned. They actually care more about what's happening in the day-to-day business. What are my sales? What are my inventories? What are my clients feeling? Than they are about what the stock market is doing. And I think that's a
So
positive.
maybe the stock market indications that you'll see are not indicative of what you will see in the financing activities.
Not at all in our business sector.
And I guess what you're seeing also is not indicative of the overall loan issues because you are not really in the housing market.
No.
And that is the one that has been most affected by the increase in rates or is less fine. Let me just pause one. Is there any question out there? If you have one, I really encourage you don't get a chance to just ask a banker anything without any repercussion. Is there one over there? Please, yeah. We have a microphone coming to you, I think. Please identify yourself as well.
Sure. Orijit Sengupta, CEO of BeyondCore. As a bootstrap entrepreneur, the funny thing is VCs are always ready to give us money. We don't want their money because they want equity. Loan is so cheap, nobody wants to give loans to even Silicon Valley entrepreneurs. So what are you doing about that?
It depends.
This is an excellent question because what you're really saying is you want to own your business, you want to get bank credit.
Right.
Here's a small, medium-sized bank. What does it take? Yeah.
So look, it's going to depend on what collateral you have, whether you have cash flow. I mean, if you have collateral, we might be able to do a lease. We might be able to finance the specific equipment that you're buying. We do that. We have Signature Financial dealing with exactly folks like you who may not be at the level where they're able to borrow unsecured. If you have personal collateral, we might be able to help. But the most important thing is cash flow. I'll be perfectly frank. I think that people say, well, I've got assets or I've got LTV or whatever. But my view is that loan-to-value ratios don't repay loans. Cash flow repays loans. So if you can show us that you're a sustainable business, I mean, we are thrilled to make small and medium-sized business loans. We think we do it pretty well. Our non-performing assets, non-performing loans to total assets are 0.19%. So we're careful, we're cautious because we worry about the depositor first. But we also try to be creative. And I think that's what differentiates us, by the way, which segues into...
Yeah.
I would just make one point. I think that's why you need to have small and medium-sized banks, because we don't just credit score people. We actually look at the old-fashioned character. We look harder at the collateral. And you're less in an algorithm than you are talking to a real banker who's going to make a real evaluation. And the other thing we say to people, by the way, is the answer may not always be yes. We turn down a lot of loans, but you get a quick answer.
So what do you think about the structure of the banking system post-crisis going forward and its ability to help the people here? I mean, you have some reservations about it, I know.
Right. I think that you would have never created a banking system that looks like our current banking system. It's like an advertisement for unintelligent design in the universe. In that we have a few big, too big to fail banks, and whether they, as Jack Lew said this morning, we've solved that. I sort of had this view of a big mission accomplished banner behind him as he was saying that, or not, and I don't think he has, and I don't think it's really been resolved. The flip side is we have a few big banks with 70% of the assets, and then we have everybody else. And it's very hard. Big banks do certain things very, very well, that we can't do. But on the other hand, they can't really look at small and medium-sized business on a case-by-case basis.
So do you see anything that will change this in the year ahead, or the year after that, or the year after that?
I think, when I said unintelligent design, to a certain degree, it was regulatory policy that got us here. In 1994, we had 50 big banks that have today consolidated into 4 big banks. I think with the right regulatory policies, perhaps encouraging outsiders foreigners to make investments in banks that can grow to be bigger, to create more competition at a higher level, perhaps carrots and sticks, which is what the administration says in terms of encouraging shareholders in banks to break up the big banks voluntarily, are all possibilities.
Are you encouraged at all after hearing this?
Well, he said asset, and if you look at intellectual property, it's very difficult to quantify it. So he's still thinking old economy, not new economy.
Well, it depends what you mean by intellect. I'm not going to review your loan request here. I want to be perfectly quick.
By the way, it's
but I have two of my
world in. We would like your loan request.
But I would like to say this, and I do think banks recognize this in terms of lending. Certain banks, small banks, and understand, for example, a music catalog. That's a sort of intellectual property that banks can get their hands around. Again, I don't know what IP you're talking about, but there's IP that's quantifiable, and there's IP that's not quantifiable.
Has that changed since you've been in banking?
Oh, definitely. I think there's more IP that's quantifiable than there was before, but it's still more difficult to frankly foreclose upon.
I can't imagine having an IP discussion with a banker 20 years ago, so I think that is we may have time for another question. Yeah, there's another one over here. Oh, there are 2 more. So let's see if we can get those in, and then your big surprises, and then we'll wrap up. Question?
Yes, I'm Tony Mace from Market News International. One of the previous guests made the case that small business is groaning under this burden of regulation. And if not for this horrible accretion, that there'd be so much more economic activity and hiring and so on. And in particular, in the banking business,
I need you to be really concise.
Anyway, so is it true? Is that reality, or is that rhetoric?
I'll react to it this way, and again, I'm channeling here our small and medium-sized clients. The issue is there is a lot more regulation than there used to be. There's local regulation, which has increased dramatically even in the Bloomberg administration. There's state regulation. New York is notorious for state regulation and pretty onerous. And then there's new federal regulations. In many cases, each of the regulations ranges between acceptable to understandable. But when you add them all up, there's actually nobody looking at the total burden of the regulation. And that is impacting businesses. I got asked the question a lot about Obamacare. Actually, in New York, that's not a huge deal because we've had such a heavily regulated healthcare market. It's not a huge delta. But if you add up all the differential regulation, people are groaning under it to some degree. Yet, I have to tell you, with all that, there is some pent-up desire among small and medium-sized business to grow and to get out of that.
Do you see any hope for the regulatory burden easing, or do you just see more and more coming down the line?
Boy, I don't want to leave us on a point of despair, but
But you would if you were being. So let's talk about your surprises, and I know there's another question going out there. Okay. What are your surprises for the year ahead?
So my surprises for the year ahead are, one, I think that Mayor-elect Bill de Blasio, recognizing that he has some issues with the some sort of trepidation and skepticism from the business community, I think he'll go very early to trying to resolve in a favorable way the union contracts that are all up for renewal. Get that done early, build some capital with the business community, and then really have a stronger hand in implementing some of the rest of his agenda with the support of the business community over the following years, sort of what Clinton did, President Clinton did.
So
with
to give
welfare
you guys
reform.
context, last week when we were speaking and I asked for a surprise, your comment was, I'm very concerned about what de Blasio will do. So this is actually a modification of your
Yes.
position. You're more optimistic that not only will he get a contract, but it won't be a contract that will bankrupt New York or anything like that.
Right,
Do you have any other surprises for the year that you?
I think the other surprise we're going to have is that despite all the increased regulation of banks and of financial institutions, that we're still going to get some bank out there or financial institutions going to not fail or fall, but there's going to be a shudder. I just think that we can't ever think that we can regulate away risk or have some wise people in Washington that'll figure out what the risks are and then make them go away. Risk is part of the system, and I think that'll underscore our need to deal with the TBTF, too big to fail issue.
Maybe we have 1 minute left. There was a question over there, so let's see if we can, yeah.
Hi, my name is Gordon Young from Ernst & Young. It seems that after 2007 that a lot of big banks have become very risk-averse, and that leaves a lot of market share for you guys. And do you see that in 2014 they're coming back, and do you see the threat in 2014, and what's your strategy around that? Thank you.
So thank you. So look, we identified that way back in 2001. We opened our doors in May 1st, 2001, and we have never done an acquisition. We started out with 0 deposits, 0 loans, and today we're a $21 billion bank in the New York area because we identified that there is an umbrella that we can sort of move below that the big banks just can't grapple with. And we can grapple with and focus on small and medium-sized businesses that they can't. The risk aversion toward dealing with those businesses, I think, are greater among the too big to fail banks because, again, they're harder to quantify, harder to put in algorithms, harder to make broad judgments over diverse geographic areas. So I think we have a huge advantage in that, and we're going to try to take advantage of it.
Thank you very much. Really a pleasure.
A pleasure.
So